Hi, everybody. Welcome to the interview on Real Vision. My name is Cormac Kinney. I'm a longtime subscriber, excited to be on the other side of your screen for the first time. I'm the founder and CEO of Diamond Standard. I'm also a former portfolio manager at Tudor and Millennium. And today we're going to talk about contrarian investing. And I'm joined by a legend in the field, Murray Stahl, the CEO of Horizon Kinetics. He's an investor that many people don't know as a household name unless they're in the industry. He has about a 30-year track record of seeing things that other people don't see before they do and getting in with conviction, whether it's in digital, real estate, macro, mining, or equities, or in my case, diamonds. Reading from the Financial Times, they had an article a couple months ago. Horizon Kinetics, the $7 billion contrarian investment firm, co-founded and headed by veteran manager Murray Stahl, has 3 of the 10 best performing mutual funds this year, according to Morningstar. Welcome, Murray. Great to meet you.
Thank you.
I was researching some of your past investments and some of the current ones, which are extremely interesting. And the range is quite astounding. I mean, starting back, I think 30 years ago, you were an investor in 3 Mile Island after the blow up. More recently, Horizon Kinetics is the second largest holder of GBTC, Bitcoin, after Cathie Wood and ARK, I think. And earlier this year, you launched an inflation ETF that this year is approaching 900 million in AUM. Now you're looking at crypto mining and oil. It's an incredible diversity. My question is, tell us about some of the things you're investing in now and what leads you to these opportunities before other people see them.
Well, at the moment, I'm focusing on assets that will be beneficiaries of inflation. Therefore, the inflation ETF is important. Not really heavily invested in gold miners. I'm invested heavily in gold royalty companies. They make money even if the price of gold doesn't go up. You could argue gold either way because it's a substitute for the dollar. The dollar has been relatively strong against other currencies, so it's a debatable topic. Inflation, I think it's more than just money supply. There are many factors structurally that are leading us to inflation. So I really believe we've hit a point of no return, and I think we're going to have a lot of inflation.
So your investors know you for investing in things like Texas Pacific with the land or the Canadian version of it. And how many years ago did you start investing in Bitcoin?
That would be roughly to the end of 2015.
2015. So you were very, very early for an institutional investor. What were those conversations like with your clients?
Well, for starters, it was only in one fund to start. So I only had to deal with a subset of the clients. And then I think as I expanded, it took about a month to expand it to all the accounts. They basically thought I was crazy.
Mm-hmm.
I'd lost my mind.
Yeah.
But I didn't see it that way, obviously. So it was only when that was explained to me in the article I read, I realized what this was, that this was a seminal advance for society. And I felt I had to be in it.
Mm-hmm.
So next morning I go into the research meeting and tell everybody, I'm going to buy Bitcoin.
Yeah.
And they thought, actually, I lost my mind. And they tried to talk me out of it. And I said, you can try to talk me out of it, but I'm going to do it. And I really did. And I was so pleased with it that I just couldn't stop buying it. And I was buying it in the form of, to begin with, the Bitcoin Investment Trust,
Mm-hmm.
because I had no idea how to hold it or custody it.
Mm-hmm.
So I was buying it in the form of security. And that's how I became the second biggest holder. At the time, I was the biggest holder
Mm-hmm.
of GBTC.
Wow.
That's the story.
So now your investors, I guess, are pretty happy with your conviction.
I certainly hope so.
So we met during COVID. We were brought together by my project, which is a little bit different. We were introduced by our common now colleague, Al.
Yes.
Swimmer. What was your first impression?
Okay, well, he had mentioned to me that you were doing some work with diamonds. I've always been fascinated with diamonds. And I'm a student of history, and the industry only starts at the end of the 19th century. It's very, very different than gold in many ways. Maybe we'll get to that. But in any event, all I knew is you're doing something with diamonds, and I wanted to read about it. So I got the prospectus for your company, Diamond Standard. I started reading it, and when you read it, usually you underline some things, you make some notations of interesting facts, and you write your questions out. So I had roughly 36 questions that to some one degree or another, they were addressed by the prospectus, but I wanted to go deeper. So when Al brought us together and I began a conversation, what was really amazing was the first presentation I ever had where you were actually answering my questions, the ones I had written down. As if you anticipated my questions, but I didn't know you. I had never spoken to you. And you were doing it in a very logical way, not exactly, but more or less in the order I had written them down. So at the end, when you completed your presentation, I had some further questions, but I felt I understood at least what you were doing, and I felt I was terribly excited about what you were doing, and I just wanted to be a part of it in any way I could.
It's like the old saying, when preparation meets luck.
Or some people say two great minds but a single thought. They say that too.
Yeah.
So tell me, Cormac, even though, how did you come to Diamond Standard? What is your background prior to Diamond Standard? And how did you come to create Diamond Standard?
So my background is computer science, and I studied at Carnegie Mellon. And while I was at school, I actually started my first software company, which ended up being something for optimization. And that really set my path, where from that point on, I really just continued to develop new ideas and turn them into companies. When I finished graduate school, I started NeoVision, which was a trading systems platform. And I designed about 100 trading systems. We were funded by Deutsche Bank, Intel, JP Morgan, and a bunch of venture capital firms. And I got to learn about all different types of trading, automated market making, fixed income, foreign exchange, commodities, and equities. And that company ended up getting acquired by the Carlyle Group, and I decided to move to the other side of the relationship. And the next system I developed was one of the earliest sentiment trading systems, where using the technology, again, from Carnegie Mellon, we used computational linguistics to read all the news and try to estimate, is the news good or bad for a stock? And of course, you need to do that on a very large scale with statistical arbitrage. And I ended up, again, getting luck in preparation. And I met Paul Tudor Jones and ended up joining Tudor as a portfolio manager in 2006, which was very good timing because we had no drawdowns in my fund during 2007 and 2008. And as a result of that, I ended up bringing that strategy to Millennium, where I ran at a much larger size, about 500 million. But over the years, I've actually filed lots of patents, and I don't measure by the number of patents, but how many times other people cite your inventions. And I did a search the other day, and it's up around 5,000 citations. So I've had a few ideas that other people have made use of. I didn't really get to use them that much, but the latest thing I've been focusing on is Diamond Standard.
Well, tell us about Diamond Standard, its origin, and what is the objective? What do you propose to accomplish in Diamond Standard?
So while I was a trader doing stat arb, my wife is a jewelry designer, and partly through osmosis, I learned a lot about diamonds, mainly because she was always telling me how frustrating that market is, and how her clients know that after they buy a diamond from her, they're going to lose half the value. And that when she buys diamonds, there's no price transparency. And I became very interested when I learned how big of a market it is, which is about 1.2 trillion, which makes diamonds more valuable than silver, platinum, palladium, rhodium combined. But diamonds were never fungible. And I realized that was what was limiting them from having price transparency, liquidity, and any use by investors because they could never mark diamonds to market. So I think my whole career brought me to Diamond Standard, starting with optimization, statistical arbitrage, automated market making, and more recently blockchain. That those technologies combined to make the Diamond Standard commodity possible. And basically what it is a physical commodity that contains a optimized sample of diamonds such that every commodity is equivalent. Whether we make them today or in 30 years, they're always equivalent.
Well, I must say, just as a comment, the first thing I had heard that you had worked on the problem of solving the heterogeneity of diamonds. And anybody who could do that, well, to begin with, it's got to be brilliant. You have to be brilliant. But in addition to that, that is an idea that really creates diamonds as an investable asset class. That's the key.
Very interesting. Now we're launching a fund together, which I'm excited about, the Diamond Standard Trust. What brought you to agree to do that?
Well, part of it is your brilliance, I must say. I don't mind. Hope you don't mind me complimenting you. But what you did is you solved the problem of heterogeneity. That means that diamonds will become an asset class. So if diamonds become an asset class, they're going to be more valuable for no other reason than just network effect. Network effect, also known as Metcalfe's law. I'll just throw in a formula. Maybe you won't use it, but people might like it. Think of it this way. Excuse me for throwing in a formula. It's very simple. People hate it, but it'll do you good. Imagine you're Alexander Graham Bell and you invented a telephone. You're brilliant, but you only have one telephone.
Not much use.
You can't call anyone. So now so you have to invent one more telephone. You have to manufacture one just to be able to call someone. So you invent a telephone, you give it to your best friend. Now you're calling your best friend. So how many connections do you have? Well, there's only, no matter who calls whom, it's only one connection. That's expressed in a formula known as network effect or Metcalfe's law. Here's the formula. N, the number of participants, times n minus 1 divided by 2. So to illustrate, in this case, there are two people. N is 2. 2 times 2 minus 1 is 1, times 2 is 2, divided by 2 is 1. Mm-hmm. You have one connection. Mm-hmm. So that's kind of boring. So you invite a third friend into the picture. Now n is 3. So it's 3 times 3 minus 1, which is 2. 2 times 3 is 6. Divided by 2 is 3. Mm-hmm. Now here's where it gets interesting. So you increased in n by 1, but the output increased from 1 to 3. Mm-hmm. Now if you kept doing that and made n equal 4, n equal 5, n equal 6, I won't do it because you'll be bored. But if you did it and you graphed it, you'll see that as n rises arithmetically by one participant, mm-hmm. the output is going to rise geometrically.
Right, the number of connections.
That's right. So that's the secret behind Bitcoin, incidentally, mm-hmm. because it started with a handful of people. Now, if you did that theoretically and then looked at a chart of Bitcoin, you say, this is a bubble. It's not a bubble. It's Metcalfe's law. The same thing is going to happen in diamonds because right now, there's not a lot of network effect in diamonds.
Right.
Because they're, at the moment, largely heterogeneous. And if you decide you want to sell your diamonds, there's a handful of diamond dealers you can go to. And if you decide you'd like to have diamonds, there's also a handful of diamond dealers or jewelers you can go to. It's not an enormous number. Mm-hmm. And that's why the market is not efficient. But as you increase the number of takers of your diamonds, if you wish to sell them, or as you increase the number of offers for diamonds, if you wish to buy them, it'll be priced in an entirely different way. And that's what makes it the idea of the trust so extraordinary. Mm-hmm. And I couldn't be more excited about it. I know you've got a lot of intriguing things, so please tell us what else is on the horizon, so to speak?
Well, we started with the foundation of a spot commodity, which is the diamond standard coin and bar. Incidentally, those two commodities represent about 94% of all the different varieties of diamonds. Each commodity contains the yield curve. So as we bring those to the market, we're consuming the entire supply of diamonds proportionally to what exists. And as you know, inside each commodity, there's a wireless computer chip. And that chip stores a blockchain token. So while the commodity is sitting in a vault like Brinks or JP Morgan, you and I can trade the token just like we trade Bitcoin. And the benefits of that are unlocking Metcalfe's law, because that token is able to create a network between all the different instances of this same singular asset, the fungible diamond commodity. So far we've launched the spot market, which will be trading soon on digital currency exchanges where people just trade the token. We recently received approval to launch futures, which will be listed on the CME in partnership with the MGEX exchange. We're also launching options on the MIAX options exchange. And we hope that after this trust trades for a while and becomes quoted on secondary markets, that'll be uplisted into a ETF on the New York Stock Exchange. We've actually already filed the S1 for that ETF. Then the last thing we're building is Bitcarbon, which is a breakthrough commodity currency.
Okay, so why don't you, I can't resist. You have to tell us about Bitcarbon.
So as I mentioned, each diamond standard commodity has a chip in it that stores a token. That token can be delivered to the futures broker to settle the futures contract, for example, or it can be bundled into an ETF basket to create new shares. The last application is if you send that token to a reserve, the reserve will issue Bitcarbon, which is a currency equal to 1/10,000th of a diamond standard coin, or 1/100,000th of a bar. That ratio never changes, so that Bitcarbon always represents a fixed share of a commodity that you can redeem. If you give back those 10,000 Bitcarbon to the smart contract, you can then redeem the physical commodity at any time. And what's interesting, and I think part of the breakthrough, is that Bitcarbon currency can be transacted on multiple different blockchains. And it has the same underlying value, which is the fractional value of the commodity being traded on the CME, for example. So it becomes, in essence, a universal currency that can be transacted on multiple blockchains, brought back together, and then converted into a physical commodity. But because all of the products, the currency, the futures, the options, the ETFs, the trust, all of them hold that same common token, all of that liquidity, that network effect is aggregated so that anyone can go from commodity to futures or to ETF or to currency electronically with very, very low friction and very, very low cost.
So what this means, therefore, is even though Bitcarbon is a coin as a digital asset, it trades on a blockchain, it's unique among the 10,000 plus digital assets in that it is physically backed by a commodity that has a real asset value.
That's right. And we call it a smart commodity because it's both physical and digital. And that integration is built in. The token is physically inside the commodity, and you and I just trade the key. And that allows, for the first time, an ecosystem a lot like Apple, where everything just works together. And it's because we created the diamond commodity from scratch that we were able to build this entire ecosystem.
It's very exciting.
Thank you. Well, Murray, it was really great to meet you in person finally, after speaking to you on the phone so many times during COVID. It's so interesting to hear your contrarian approach, how you've consistently found these gems, including Diamond Standard. So I appreciate your participation in that. And I'm looking forward to launching the Diamond Standard Trust with you.
Yes, well, the pleasure is all mine. And as far as I'm concerned, you're an extremely brilliant person. And it's my honor and privilege to be associated with you in any way. And I'm proud and overjoyed of being investing with you in the Bitcoin Standard company. I mean, the Diamond Standard company. I was thinking Bitcoin. I meant I'm pleased and proud to be investing in Diamond Standard. Well, I'm very happy with Bitcoin as well.
Absolutely. Thank you very much.
Thank you.